Please join me in welcoming Jun Pan from Shanghai Jiao Tong University, formerly a colleague of ours here at MIT Sloan Finance Group. Who's going to be talking about option-implied crash indexes. Jun?
It's a great honor to be invited to speak at this conference. So when Andrew asked me to emailed me, I actually responded right away. But like Steve, we didn't really have a paper. So in a way, this deadline pushed us to write the paper really quickly. But this is still a very, as our discussant maybe will recognize, it's still a very rough draft. This is the first time I'm presenting these results, so looking forward to hear the comments. So let me, as an introduction, let me just say this paper is very much based on the seminal work by Black, Scholes, and Merton. Back in 1994, when I was a PhD student in physics living in New York City, somebody told me that I should read Capital Ideas. So I read that book in the subway going through Brooklyn and Manhattan. And there is one chapter, exactly Black, Scholes, and Merton. And what's nice is that they also have pictures of these three people. I never met them. But that chapter really changed my whole career because I started as a physicist and then I moved on to become a finance professor at MIT. And in between, and I thought, well, I should really do a PhD to learn finance well. So as soon as I read that chapter, I started to apply for PhD programs. So I thought, well, this work was done at MIT, so I should apply. I didn't really know that by then the three of them have all left. But luckily, Sloan didn't admit me. I was rejected by Sloan. So I went to Stanford. And that dream of working on options never died. So at Stanford, I wrote my thesis. And so this was my thesis at Stanford. So I wrote my thesis on options. And because of that thesis, I was included by MIT. I became an assistant professor at Sloan. So that was kind of my whole path of my connection with this very important work. Without that work, probably I would be doing something else. So building on that work, initially, when you think about this whole setup, it's a pure diffusion setting, complete markets, you have replication. And this paper is going to be very important for what am I doing today, is that you add jump. So Bob, in 1976, add jumps to that original setup. So you allow market to crash. And in relation, there are also, since this is at MIT, I also want to mention that John Cox and Steve Ross also have a paper on pure diffusion. So starting from that start point, and it's very nice that I'm following Steve's presentation, also Emmanuel's presentation, is that there is limitation to the Black, Scholes, Merton setting. So the reality is not a pure diffusion setting. So these models adding expand this model to be more inclusive of what's happening in reality. So first you have John Howe is here. You have Howe and White, Stein, the Hester model. These models include stochastic volatility. So now you allow volatility to have its own Brownian motion, and they're moving along. And based on this model, put together with Merton's model, you have these jump diffusion models. So you have Bakshi, Cowan, Chen, Bates, and also with my two advisors at Stanford, we have option pricing solutions for these more extensive jump diffusion models. All of these models are built on this really important framework, and then to have reality of stochastic volatility and jump into the setting. So personally, I'm more of an empiricist, so I like to bring the data to the model And if you look at the empirical evidences, so there are various approaches of applying the model to the data. And this evidence points to the fact that in reality, there is stochastic vol, there is jump. Okay, so this is the overall setup of the literature after Black Scholes. If you think about beyond Black Scholes and Merton, this is the overall literature in that tradition. So what we're going to do is, to summarize, is really model data, and you want to come up with risk measures, extract information from the data. So the starting point is that you think market prices are being traded by different investors. So as investors are trading, the market prices of these options, they contain information. So what we want to do is we want to extract information from these prices, and we do so using models. So the first model, if you think about the first measure that's very empirically oriented, very helpful, is the Black Scholes implied vol. Okay? And back to the model gives you this very important coefficient, the sigma, introduced by the Black Scholes Merton setting. And you apply that model to the data, you get the Black Scholes implied vol. You're saying, suppose the market prices are priced through this model, and you put in the sigma, you get the price, then you look at the price and you back out the sigma. Okay, so it's very nice to saying, in reality, we know that markets are not a constant volatility. This is very obvious, but still this sigma is very useful to extract information from the data. So what we want to do is really join this approach. And also, I should say that this, if you look at I'm very glad that CBOE, Henry and Adrian are here. When you think about the application that become very popular is the VIX index. And the VIX was initially introduced as that sigma, 30-day sigma. So in parallel to that setting, what we want to do is we bring Merton in his jump model has this jump component. That jump component is dictated by this Poisson arrival. Once the jump arrives, there is a mean jump size. There is a jump component, and that jump has a mean jump size and its own volatility. So what we're going to focus is that mean jump size, mu. So if you want to plug in number, that would be 1987, October 19th, the mean jump size was about minus 20%. So that's the mu we wanted to focus on. So we're going to build on these models, and the key parameter, instead of sigma, it's going to be mu. And the application, instead of the VIX index, will be the option-implied crash index. So you can see we are trying to map to that expression, and we wanted to say maybe this could be another CBOE index, would be the 6, the crash index. And that index, the key observation is the mu, the mean jump size, the expectation of that crash. And also, Steve mentioned earlier, and also there is another tradition of using non-parametric approach. Actually, Yassin and Andrew had an earlier paper doing kind of what Steve is doing, the Q distribution, the risk neutral distribution, using Doug Breeden and Litzenberger's approach. So here, if you think about the mapping between VIX and the sigma, so later on CBOE, along with the Goldman Sachs white paper, they updated the VIX. Now VIX is not sigma, not 30-day sigma, but this is not the non-parametric approach. But you plot these two together, they're very similar. Okay? So another way we can think about our crash index, well, it's going to be the option-implied skew. So we can do a non-parametric skewness estimation, and we can relate that skewness to the 6 and to the mu. Okay, so you can see there are it's kind of a two parallel universe. You have sigma, you have option-implied vol, you have VIX. And here you have Merton's mu jump size, crash index, and the the option-implied skewness. Okay, so this is kind of the roadmap of what I'm gonna present. So going through the model, given the interest of time, I'm probably not gonna be able to go through every components of the model. This is a jump diffusion model with the P dynamics and the risk neutral dynamics. You have two Brownian motions. One Brownian motion governs the stock return, and that Brownian motion also shows up in the stochastic volatility component. This is the Brownian motion that focuses just on the stochastic volatility, and having this rho introduced this well-known correlation between volatility and volatility shocks and the stock returns. And on top of that, you have this jump component. That's Merton's jump. But what's unique here is that now we have this V, which is a new state variable in the model. So this jump arrival intensity, we make it as a linear function of V, meaning that jump is going to be more likely when the markets are more volatile. Okay? So this will be the jump arrival intensity lambda times V. Mu st is the percentage jump, conditionally on the jump happens. Okay? So these are the three shocks in the model. If you compare the P dynamics with the Q and these red lines here, this tells you the market price of risk of these three shocks. The most important market price or the most important difference between what's happening in the P, what's happening in the Q is this piece. This piece has two components. One is lambda times Vt, that's the jump arrival intensity. And we make it linear in V, making it more likely when markets are more volatile. And then you have a P jump, mean jump size, and this is the Q mean jump size. And this is a very interesting component by saying that in the P, there are jumps, and jumps, we saw the worst ever was 1987. Then we have 2000, COVID period, we also have these crashes. And then we have this mu star, which only shows up in the Q dynamics. They only shows up in option prices. So the tension between these two, what you actually observe versus what's being priced in the option, that's going to be the key component in our study. In a way, the crash index, we're going to extract, focus on the option implied. So that's what we want to do for this paper. Option pricing within the setting is well established. Let me skip. Before we can apply the model to the data, we have to estimate the model. It's as you can see, it's a more evolving model than the Black-Scholes. When you do Black-Scholes implied vol, the only unknown is sigma. But when you do the jump diffusion SVJ, I'm going to call it SVJ, stochastic volatility with jump model. When you do that implied crash index, now you have a lot of parameters to estimate. Of course, they show up in that model. So the estimation actually is quite involving, but this is given the limitation of time, I'm not going to go through too much. Let me just say one thing that's really important for us is the V. Because with the stochastic volatility model, we now have this state variable V. Where do we observe it? Steve had the same problem early in his same issue to address in his presentation as well. So here, we're going to infer V from an at-the-money call option through the model. So if you think about this is the model's pricing function, then you have the model implied option price. This is the market price. You make them equal. The only thing you're going to use is this VT. So in a way, you infer VT from an at-the-money option. So in a way, when you look at the model, we are saying, in the model, the key state variable is going to be informed by this at-the-money option. And the crash index is going to be informed by these out-of-money puts. Okay? So we're going to fix the model first, also with the parameters. We have I don't have the parameter listed here, but we have a bunch of parameters, okay? So we're gonna fix all of these parameters, do the estimation, so the model is informed by the time series of the joint time series of the SP, the cash market, SP 500 index, and the at-the-money options. That's the key information feeding into the model. Once we do that, we're gonna fix the model, and now we're gonna focus, I'm gonna skip a few slides. And now we're gonna focus on the crash component. How well am I doing? 5 minutes, okay. So I'm gonna have to skip a few slides. Let me just give you a sense of what the model does. This is the very famous SMILE curve. This is the y-axis, Black-Scholes implied vol. X-axis, the strike to the spot ratio. Moving to the left, these are out-of-money puts. This is the model implied smirk, so that you know that with jump component, for example, this is different jump arrival intensity. This is the different mean jump size. That's the key variable we're gonna use. You can see by dialing up the mean jump size, making it more and more crash-like, you make the smirk more steep. So this is exactly why we are using this model, because the model can accommodate that, okay? But in the estimation, we're gonna allow the model only to listen to the at-the-money option and the cash market. And then we're gonna turn around and say, what about the crash component? Can we learn about the crash component by looking at these out-of-money puts? Because these out-of-the-money puts, they're the most sensitive to crash. So this is, in a nutshell, what I just said. We have the data which are average. This is what the SMILE curve look like in the data. This is what the blue line is, what the model can offer. Even though you can see the differences are very small, but the difference is what we're gonna explore. You're moving to the right panel. Again, x-axis strike to spot price, but now the y-axis is the model implied mu, the mu star I just mentioned. And according to the model, just like according to the Black-Scholes model, sigma is gonna be a constant. So according to the model, the mu star is gonna be a constant. But in the data, you can see that the mu star are very different, and it peaked around for these out-of-money puts, striking about 5% out of the money. So the difference between the red and the blue is the key inputs for our crash index. In other words, the crash index information comes from these type of options, from this type of out-of-money puts. Okay? So this is what we actually do. So I'm gonna skip the detail, but just saying we're gonna fix the model to the at-the-money option. And the model is the stochastic volatility with the jump component, so it can already accommodate the SMILE curve. But then we use this out-of-money put option to extract information about crash. We want to listen to the pricing of these out-of-money puts. We want to see, oh, how big of a crash, how big a mu star does the option market price? Okay? And this is what actually the crash index look like. So the blue line are the crash index on the left axis. The red line are the VIX. So I want to compare it to the VIX. The first thing you see that it's actually not very much related to VIX. It's actually, the crash index, it's a force by itself. If you look at these numbers are effectively Merton's mu, except that with a negative sign. So we want to say that on average, the crash is, let's say, 16%, and the crash index will be 16%. But the mean jump size is negative 16%. Okay? And a few interesting patterns here. One is post-2008, that crash index actually, there is an overall, it's a very interesting pattern. Post-2008, the crash index actually has an upward trend. Another interesting pattern, and if you can give me some hints, it would be great, is that we actually find a peak in 2017, for 2017. That was 20 years anniversary of 1987. But and also in October. Another is, of course, the more recent inflation, monetary policy in response to the inflation. Okay? So that's one angle. Another angle we want to explore is, well, I'm going to skip that, is that what about these non-parametric skew? Because you know.
Sorry, 16%, but how often?
Oh, very often. These are risk neutral intensity. Let me tell you how often. So this is the jump arrival intensity. On average, it's about, these are risk neutral jump intensity. So on average, this is about 60% per year. Remember that our jump intensity is a linear function of V. So it moves around. This was the time when I first wrote my thesis. So this is actually the first time I'm looking at the new data, and you can see 2008, COVID, and the jump intensity becomes 8 times a year or 9 times a year. It's a time variance, so it's a very jumpy. These are all risk neutral, though. So this is very much related to what Steve just mentioned, except that we don't use the distribution, we look at the moments. So for CBOE, this looks very familiar. This is their VIX. This is how they construct VIX, second moment. So here our contribution is the third moment. Yeah, and you know that the third moment is going to be very much related to the mu, to our crash, because negative skewness is generated by crash, especially for the short-dated options. So it will be a sanity check for us to compare this non-parametric approach of skewness to our crash index. And this is what it looks like. The blue line is, again, our crash index, and the red line is the skewness. And you can see what the negative of the skewness, of course. You can see they are very highly correlated, not 100%, 65% correlation. If you look at daily changes, also 65. So this tells us that the crash index we capture is not some random noise. It's really informative. Conversely, this also tells us that the skewness, a major contribution, a major driver of that skewness is crash. So we have a few other, given the interest time, let me just stop by pointing out, showing you 2 tables, and then I'm done. Do I have a, is that 5 minutes already? So yeah, okay, so just 2 more tables, then I'm done. Sorry about, maybe I'm running over time already. First is, we want to say what's driving that 6? What's driving that crash index? Interestingly, what we put in FOMC, we're putting different calendar days. Probably the number in the square brackets are the t-stat of these regressions. So third Friday is significant. That's the role of these options. But significant not in big magnitude. It's only 1.7%. Well, not surprisingly, the skewness is very significant. It can explain 40% of the R square of the 6 can be explained. Steve mentioned earlier about the return the day before, the SPX return the day before the measure of that 6. And you can see that when the markets actually dropped, 6 increased. But also not hugely important. Then we throw in a lot of, just like Steve, we throw in a lot of other well-known market indicators to trying to explain 6. And the results are quite make sense in terms of what's the information content of 6. Okay. Another dimension that's interesting is once I have 6, what can I predict in terms of the future? Okay. This is probably an intuitive way to look at the results, is that we sort changes. So it's the innovation of the 6. We sort it into when the suddenly crash index increase. So this is the 2% tail. These are the days when, moving from yesterday to today, crash index increased by a large amount, and they show up in the 2% tail. Okay? And this is the SPX return on the next day. You see that it's minus 47 basis. So minus 47 basis per day on the SPX is a sizable number. And these are the t-stat of that number on average. And you're moving it away from the tail, the magnitude decrease slightly. Okay, good. So overall, it's telling us that the crash index is more informational. It's telling you that when the 6 increases, yet the day after, the markets drop, okay, on average and in the tail. This actually is very interesting comparison with VIX. When VIX increase, you may think, well, 6 and the VIX, they're the same thing. No, informationally, they are actually opposite. When VIX increase, like say 2% tail increase in the VIX, the day after the markets actually increase. Why? When VIX increase, there is a heightened uncertainty. And the next day, there is a resolution of uncertainty. That's where the markets actually increase. So 2 very different channels in terms of predicting the future. So I'm running out of time. Let me just conclude. We construct a option-implied crash index by exploring the price difference between out-of-the-money puts and the at-money options, and the benchmark is the SVJ model. So it's not a pure diffusion model. The model itself already allows for jump for the smile curve. And that construction is analogous to VIX. The mean jump size corresponds, the mean jump size mu of the SVJ model is implied by out-of-money puts, just like the volatility parameter is implied by at-the-money calls. Empirically, we find that this index is closely related to the non-parametric skewness. And I didn't mention that result. It's also positively correlated with the put-call volume ratio. Post-2008, we find this intriguing increase in that crash index. It feels like options market are pricing more crash or more worried about crash post-2008. We also find that after large increases in 6, there is a negative jump in the SPX in the stock market. This is to be contrasted with the VIX measure. After large increases in VIX, actually markets, there is a resolution of that heightened uncertainty. Market actually improves or has a positive return. Okay, so that's all I have.
Well, thank you so much for this great event and also including me in this. I really enjoyed this paper, and one thing before I discuss the paper I want to share with you is that these 2 gentlemen here are very unique in the world of research and academia and ideas because they did everything. They did the science, they did the engineering, and then the practice. So they did the thermodynamics, they did the internal combustion engine, but they were not just happy with that. They went into the racing arena, they smelled the gas and the oil, and they changed the tires. And because of that, I would like to present my comments along these 3 dimensions: the science, the engineering, and the practice as it relates to this paper. The science, first of all, it's a very well-motivated paper. Everybody here who participated in the financial markets is so worried about a crash. And we know that because a crash is really like a big earthquake in the financial markets. And it's the day when careers are made or lost, fortunes are made or lost, registration gets changed, politicians get changed, people in CNBC get the red banner and start screaming. So it could be great if we can find something that can give us an indication that this earthquake is coming. And this is a very motivating, a great motivating question for a paper like that. So let's just talk a little bit about the science. And the way we do science is we construct a fictitious world that we hope that kind of describe the real world and examine what happens in that fictitious world. So the world that Bob and Myron the late Fisher-Black, was a very simple word. We had one thing that moves, which is the stock price, which is described by one parameter, which is the volatility. They milked this very, very well and managed to get a lot of it. But now we are 50 years later. Our colleague here is using the latest science. So that fictitious word that she is dealing with has three things that move. Has a stock price that moves, has a volatility that change, and also has a crash that could happen. She also has a risk premia that the investors are paying for all of these. So we moved from Bob and Myron, one parameter, one world, into a 10-parameter world. And that's kind of the science that has been done. They were also very clever in figuring out a closed form solution for option pricing for their world. She's using the latest and greatest in analytics in figuring out the prices of options. It's an appendix P in the paper. I spent a night trying to understand, way beyond me, but I know that it makes sense and there is a way for calculating option prices there. It's not gonna fit on the Texas Instrument calculator, but it's probably gonna be on an NVIDIA chip. So they did that, they are using the latest, and that is the science piece. So now we go to the engineering piece. What is that fictitious world that she found, and how does it compare to the real world that we live in? And I was very, very excited going through this paper. They used 30 years of data, and every day they take the price of the S&P and 3 options. So 4 data points a day times, I think, like 8,000 days. So a lot of data in order to figure out these 10 parameters. And they produced this world for us, which she showed you here. I'm a simpleton, so I tried to translate this world into a language that I can understand, I can relate to. So the first thing is, what is the average volatility level that kind of her world, that they found in the data for that world? The number in the data is 10%. S&P volatility for the last 30 years averaged to 10%. And I just couldn't help myself, but I looked it up on the data on Google and said, what was the realized volatility average over the last 30 years? A number was 15%. So one question mark for you, why is that number your average? 2/3 of what the statistical number is. So that was number one. Number two is, okay, I have been through many earthquakes. So whenever I hear the word crash or earthquake, I am thinking a drop of 10%, 20% of the S&P. So I looked at the number, what is the data saying about that number that is expected in the jump? And I calculated many times, and the number is 1% in a day. So I just scratched my head. I said, see, that's really not a crash. This is, well, today the market is more than 1%. I am not feeling an earthquake. So I'm very puzzled why the number that you come up with is 1%, not 15 or 10%. Then I looked at the risk premium. What are the risk premium that are implied by the numbers here? Well, the total risk premium is 7%. So, okay, that's probably reasonable. It doesn't include the dividend yield. Maybe when we throw the dividend yield, we get a higher number. But then I broke it down into the risk coming from the normal, everyday, run-of-the-mill volatility versus the crash risk. And the risk premium that gets attributed in your fictitious world to the crash is 4% out of the 7, and 3% for the normal volatility. So I said, okay, so I'm a person here. I think that the market is going to drop 1%. That's my kind of risk with a probability of 10 basis points a day, and I'm going to demand 4%. That sounds out of whack. Have you told me that the risk is 15%, I might have said that, but the risk is low, the risk premium is too high, at least in the numbers that are presented in the table. But nonetheless, I think it's a great technical achievement in figuring the prices and fitting all of this data. And now we move into the practice part of it. This is the VIX index. Everybody calls it the fear index, and I really don't like this at all because it's also the hope index. People buy call options pay for it because they hope. It's not the fear index, but your index is going to be the fear index. This is the crash. But is that something that we really can implement? Well, the problem is not everybody has an NVIDIA computer that they can use in order to compute the CIX index. The beautiful thing about the VIX index is just a very simple formula. It's a formula that can be calculated very quickly. In fact, our friends at the CBOE calculated, I think, every couple of seconds. So it's going to be very hard to produce something like the CIX without going through this very advanced machinery. But maybe it's a business opportunity. You can develop that machinery and help the CBA get the data and print the CIX. So in summary, it's a great technical piece that is using the latest science, great technology. I have many questions about the numbers. It's probably my misunderstanding of some of the data or interpretation there. And it would be great if that can be clarified and connected to something that the average investor can understand, especially if we're going to make a product out of it. Thank you.
June, do you want to take a minute to respond to Ayman before we open it up for questions? Yeah, please.
Thanks, Ayman, for very detailed reading into our paper. So the V-bar, the long run mean of the volatility, 10%. By the way, the paper was joined with my colleague at SAFE, a junior faculty. He did all the estimation. So the estimation actually is very involving. So for sure, I think that estimator needs to be updated. So that estimation probably is the moment condition was not strong enough to force the long run mean to be, let's say, 15%. In terms of the jump, you mentioned 1%. That's the P measure, NOP. So that if you look at the actual dynamics of SPX, the returns of the cash market, actually it's not that jumpy. You have a few like 87, COVID, but on average, the jump size are not that big. So that's why the option market, you see this mu star, the jump size like 20% or 15%. The gap is exactly what I believe is the jump risk premium. Or people are so afraid about crash when they are buying these puts that willing to pay a premium. That's where that gap comes from. Your observation about equity premium is only 7%, but 4% comes the jump component, and yet the jump component accounts for only a small, tiny fraction of the variance. This question was asked by Stu on my job market. I don't know if Stu you still remember, but in your office, you asked me exactly that question. And well, first of all, it's estimated using the joint dynamics of stock and option. But second, I think this really tells you that when it comes to risk and return trade-off, it's not mean variance. So the jump piece probably is highly compensated relative to the variance piece. And I stand by these estimates. Okay. Last is since CBOE, CBO people are here, our estimation is very involving. It takes a few weeks to do. But what's nice about this approach is that once you estimate the model, everything is already set. Because just like the Black-Scholes model, everything is already set. The parameters are set. You don't need to re-estimate it again. You only need to use these out-of-money puts to infer the mu star. Other parameters you don't change anymore. V, the implied variance, implied stochastic volatility, you don't change either. So that calculation can be done really quickly. So it's still applicable if there is interest.
Okay, questions from the audience? Arun in the back? Oh, sorry. Arun maybe first, and then Emmanuel second.
Thank you, June. So I play in the world of the institutional investor, and for them, a crash is not a one-day 5% move. It's a secular decline of, let's say, 20%, because that disrupts the entire operation, right? Because now they've got illiquid assets which can't be rebalanced. They've got all these funded issues that start to kick in. So the question is, are you measuring something that doesn't have broad application, even though it's an attractive index? And like Ayman said, anything that can predict a crash is extremely valuable. The question is, are you measuring the right crash? And is there more value in capturing a potential 20% peak to trough drawdown than a one-day 5% move or something like that, right?
Thanks for the question. By nature, our estimation is more high frequency, short-lived. But you can see that there is an overall trend of 6 that we can, of the crash index that we can capture. But day to day, this is really not for the domain of maybe long-term investor, but more day to day, what's the impending risk that's coming up. So more high frequency, I agree with you. We can use long-dated options to do that, but I feel that this is, maybe I'm wrong, but I feel like options market, the most liquid contract comes from the short-dated options. So I think the information that I brought to the market is really coming from these short-dated options. So you don't have a long, like a secular trend. For a secular trend, probably you don't look for the SPX options. People don't trade that. Yes.
Yeah, I haven't read the paper, obviously, but following up on what Ayman said, don't your implied numbers for the probability of a crash and the size of a crash imply that, in contradiction to Myron, that the option market's actually inefficient? Because people are paying for a much bigger crash much more frequently than it actually happens.
Because there is a risk premium. A crash, people, in order to ensure that crash, they're willing to pay a price that's higher than the actual crash.
So you could make money by selling?
Make money, yes, but not necessarily inefficient, right? You're providing an insurance. So there is a risk aversion component to it. And that risk aversion is not the mean variance risk aversion. It's risk aversion to the jump component that's probably is more severe.
Yeah. So if you're an individual investor and you know this crash index, CIX has gone up, would you actually trade on the, get out of stocks because, or would you say to yourself, well, it's up because I've taken, I'm part of the entire index. My behavior is part of the index, so there's nothing for me to do. It's just why, why things are where they are right at this moment. Or do you think there's a bunch of people out there that are somehow not connected to this entire world who will look at this and then trade and say, oh gosh, it went so high. Now I really have to start thinking about what to do. I'm trying to figure out the practical implications of this for the individual household.
Individual household, maybe not so much. That would be my reaction. This is more, as an empiric, well, I have been an academic for my entire career, so I haven't been practicing. But in terms of the meaning of that measure is really to extract information from the options market. So what are these option traders thinking about? And that's what we are able to back up. So in terms of individual investor, maybe not that useful for them.
Okay. Actually, maybe I just did a stupid test, but I said, what if I bought, and I just empirically did this, looked at what if I bought options from, say, 1996 to current time, such that I protect my downside to be no more than a loss of 30% a year, okay, by rolling puts, and making sure that I always can protect myself by rolling puts and repurchasing puts and buying new puts associated if the market get a high water mark. So I'm going to protect myself from the high water mark. But if things go down, I maintain my positions. And the cost I found of rolling these puts and protecting my downside against normal times and shock times was only about 2% a year, for 30% down. So, basically, I think that a 30% down is closer to a shock than a 2% down or 1% down or 10% down, because those are sort of within fluctuations. And it's when you get these large drawdowns, 25, 30, 35% down in the market or even higher, then you have to have people doing huge rebalancing of their portfolios. So the numbers that Ayman referred to, seem in your paper seem to be way too great in terms of premium. If I look at the actual premium and it only measures to be 2% for a 30% drawdown.
So what type of options did you use to do that exercise? It must be at the money options, right?
No. Yeah, I mean, basically, well, the options that I used was rolling it so that basically if you had the stock market went up, you had to buy in your old options and rewrite a new option at the higher at the strike. So
it's at the money option.
Right, but it's the same thing. It's rolling it all the time to protect yourself against the 30% drawdown. You won't get greater than 30% drawdown.
So the pricing of these options, in terms of what we are capturing, actually is that, in a way, it's at the money option is being taken care of by VIX. And here we are focusing on out of the money option, linking it to the crash index. So maybe.
I think that if I can have a simple strategy, okay, that protects myself down 30%, I won't lose more than 30% because that's when I'm rolling the puts, okay, and if I get a new high water mark because my stock goes up, I buy puts to protect the new high water mark, so I don't lose more 30% for my high water mark. It only costs me 2% a year. That to me is an indication of what the cost is of protecting myself for the 30%. If I use different numbers, obviously 15%, the cost would be higher. If I use 40%, the cost would be lower. But at least a shock of 30% is an indication to me that that's something to worry about.
I'm curious about your observation about the difference before and after 2008. And I'm not sure it applies so much to short-dated options, but did you look at the sensitivity to the interest rate levels pre and post? Because there was clearly a change in monetary policy at that point. And the second part of my question is whether you've ever looked at, like looking at the real interest rates, inferred by tips, and whether, you'd think that the cash market and the tips market would be joined at the hip and there wouldn't be any difference. But I'm kind of curious, especially for long-dated options, whether the tips gives you any more information content. Using the yield on the long on tips for longer data, it just seems to me that using real interest rates would be different. It shouldn't be that much different, but I'm just kind of curious about whether you looked at that.
Yeah, I think our estimate post 2008. Well, I was told that post 2008 is at the money option. Their premium actually shrank. So our overall trend is really for the information that's contained in the out-of-money puts. So there, in a way, there is, I think, a gap that's widening between at the money and out of money. So we probably want to re-estimate the model again for just the post-2008 period, maybe re-examine that trend. But as to fixed income market yields, we did put it there. In trying to explain that crash index, we did look at interest rate, the slope of the term structure, credit spread. They are not very much. There is some correlation, but not very strong.
Any other questions? Actually, let me ask the last question to you, June. Some of you may know that the VIX index has an offshoot called the VVIX, which is the volatility of volatility. And it might seem like that's a bit self-referential, but I would think that that would have some bearing on your crash index.
Yes,
Have you looked at
yes,
VIX?
no, not yet, because to do that, I need to add a jump component for that stochastic volatility piece to make it better.
Yeah.
So
One thing you could do now, though, is take a look at what happens to the VVIX after your 6 index goes off the rails, or in that
Right.
2%, because that might be an interesting,
Yes,
coincident
yes.
indicator.
right, yeah, I think VVIX will be a very interesting thing to look at. Yes.
Okay, please join me in thanking June.